For those of you joining that it's your first time, thank you for attending. We've been hosting these monthly webinars all last year. We did a couple different webinars last year to everyone on our list, but so far we've had a growing response. This month we had just under 100 people register. So thank you everyone for jumping on today. I know taxes are top of mind this time of the year, so let's dig deep without making it too boring. So stick with me everyone today. Anyone that's in the room, if you could raise your hand or let me know in chat that you could hear me okay, that would be greatly appreciated. And we'll jump into the presentation then. Okay, I see about 10 hands up and a couple here. Good to go, good to go. Well, let's jump in here. So this past weekend, we had one of these traumatic parent experiences. Eli, our 4-year-old son, was screaming, "Dad, Mom, no, it hurts, stop, stop, stop." I said, "Eli, just be patient, it'll be better, it'll be better." And really, that's one of the hardest things to hear as a parent, right? Well, what had happened is we went to this really cool playground in our area. That's one of these wooden castle looking like ones. In fact, there used to be one in Cranberry when I was growing up. And it was the coolest playground to go to, and the boys love it. Well, if you have young kids around wood structures, we know one thing is eventually going to happen. They're going to get splinters. Well, Eli got his first splinter this weekend, and it was not an easy task to get it out of his hand. He really fought us with it, and we had a conversation and said, Eli, I know that it hurts, and Mom and Dad really aren't trying to hurt you, but if we don't get it out, well, it's certainly going to be worse for you. So we want to get this out to make sure that you're safe and that you're protected. So bear with us here, buddy. And it's a tough thing to hear, but he listened to us and we got it out, and I'm happy to say that he's safe and sound. So all is well. But in reflecting on this and his discomfort, I sort of had a good laugh about this, because in some ways, when we talk to clients about taxes, it's the same way, right? They're all kind of a thorn in our side, so to speak. We don't like paying taxes. It is a necessity. Certainly, we like the country that we live in for the most part. We're all very proud to be American. So I applaud you for listening to me talk about taxes today for about 45 minutes. Hopefully you learn more, and maybe we can reduce that pain in your hand, even if it causes a little bit of short-term pain to do it. So let me jump into the PowerPoint here. And swap these out here. So again, if you're new to these monthly webinars, I'm Josh Leonard. I'm a financial planner and vice president at the Leonard Advisory Group. I thank you all for attending. We do have a general disclaimer. Today is not individual advice for you. We're going to talk in general about rules. If you're looking for individual advice, please schedule a one-on-one with us. We'd be happy to look at your situation in a little bit more detail and help guide you in the right direction. As I mentioned at the beginning, I am a financial advisor. We help people prepare and transition to have a successful retirement. We'll talk about taxes today, but I am not a CPA, nor do I prepare taxes for our clients. We'll talk about Social Security a little bit, and we are not affiliated with the US government other than paying taxes like everyone else. That's the general of this disclaimer. If anyone would like a copy of that, let me know. I did let you know about Eli. Here he is playing on a separate jungle gym, but one of the greatest things that I see in the work that we do is seeing the impact that us helping people with their finances has on them personally. And for many of our retired clients, much like my parents, one of the greatest joys in life is having additional time to spend with their grandkids. And maybe that's taking them to the playground now that it's getting warmer out, or maybe it's helping out their parents in difficult times like these, where lots of kids are home or home a lot more. So maybe just helping watch them 1 or 2 days a week. We take a lot of pride in helping people achieve what they want to do with their money, not just necessarily talking about all the details of it. So I am going to talk a lot about taxes today. Really going back to 2017, we've been in a time of drastic changes with the tax code. In 2017, we had the Tax Cuts and Jobs Act, or the Trump tax cuts. Then at the end of 2019, we had the Secure Act, or Setting Up Every Community for Retirement Enhancement Act. Then we had the first stimulus package, or the CARES Act. So in March of last year, they passed this act to give some economic relief and relief to businesses, individuals, and also certain institutions. Just last week, we had the American Rescue Plan, or the third stimulus package pass. So we're going to factor all these into the presentation today. Since the American Rescue Plan just passed, we're going to talk in a little bit more detail about that act versus some of the others. But there has definitely been some changes. So let's talk through those and talk about taxation in general. Always like to set the stage and give a tone. Today we're going to be talking about taxes. We see taxes as one piece out of a five-pronged retirement approach. We certainly don't want everything to be focused on investments. While your investments might be the engine for your retirement plan, we need to make sure that we're able to generate enough income from those. We also want to make sure that taxes are low enough. We want to make sure that our income, investment, and tax plan is not negatively affecting our health plan as well. And when we're done with our assets, we want to make sure that we're leaving a legacy that's not going to cause tax problems or other financial problems for our family. So today we're going to focus on taxes. We'll touch a little bit on some of these other areas of planning, but again, make sure that you're viewing this only through the lens of taxes, in that there's a lot more complexity in your total retirement plan. So if I say, hey, this might be a good idea to minimize taxes, that doesn't mean that it's the be-all, end-all in your plan. All right. Enough with that jibber jabber. Let's get going. For anyone that that is participating in today's webinar, you will have the opportunity to complete a form. I will send you a link throughout the presentation. I will also send you an email at the end of this event. If you complete that feedback form, you'll have the chance to win a $25 gift card. I'll be doing that drawing on March 26th. If you schedule a tax opportunity meeting, so if while covering the material today, you say, hey, you know what, Josh, I need to dig deeper into this, or I have additional questions on this, schedule that tax opportunity meeting. You'll have the option of doing a phone call or a Zoom meeting, whatever's more comfortable to you. And the third way you can earn an entry is to follow us on social media. So these types of webinars and different things that we're doing, we are trying to post onto social media to help you be able to digest the material whenever it's good for you. So by following us on social media, you help us grow that audience and also give yourself the added benefit of being able to view things or reminders without me constantly pounding your inbox with emails. So I encourage you to do that. Today, we're going to talk through three different sections here. And the first one that I'm going to cover is the American Rescue Plan of 2021, or this third stimulus round. The biggest piece that the news is focused on is, of course, the $1,400 stimulus checks. We have had some unemployment expansion to help cover those that are out of work, and also some federal support for health insurance. Now, this isn't everything that's in the bill. The bill is huge. There's a ton of information we can cover there, but these are three key areas that we've gotten a lot of questions about that I wanted to cover in a little bit of detail today. I'll also be recording a video later this week that'll be posted on YouTube and social media as well that goes into a little bit more detail in some of these. That video will sway a little bit towards or will be more important for those that are a little bit younger. So a big piece of this plan that I'm not going to cover today is a lot of the child care, dependent care credits in there that have really expanded. So if you have children closer to my age with young kids at home, those can definitely benefit them. So it's a good thing to learn a little bit more about. So let's talk about the STIMI. Hashtag STIMI has been a popular way to casually talk about the stimulus checks. So I found this great meme here on Reddit that says, gonna use my $1,400 stimulus check to see if I can get my $1,200 stimulus check to come down from the roof. Now, while this is definitely not the intended purpose of it, of course, we know some people are using this money foolishly. Another way that we see sometimes the money's used foolishly is trading in high-risk assets. So here I said it's not intended to increase the price of Bitcoin or day trading. Luckily, we've seen a really good trend with these stimulus checks, and that's Americans are saving more money. So that's a check mark. That's a good thing. One of the problems that we see is a lot of people are going into high-risk investment vehicles in search of higher yields. And while things like Bitcoin or maybe buying individual stocks, like one or two individual stocks has done really well for some people, and those are sensational stories, many times that's a double-edged sword. When the market goes down in those individual stocks or new assets like Bitcoin, we have investors become discouraged for the long term, which can hurt, of course, their very long-term retirement plan. So we want to be careful there. Anyways, on the $1,400 stimulus plan, that is $1,400 per eligible individual. This was expanded to cover all dependents. So if you have maybe a parent or a relative that you're taking care of at home and claim as a dependent on your tax return, that $1,400 would cover them too. If you have older children still in college, that again, you're claiming as a dependent on your tax return, you could also receive that $1,400 for them. In order to receive it, your income must be below $75,000 if you're filing single, or $150,000 if filing joint. Now, the phase out on this stimulus package is a lot quicker than the other ones. If you're married filing joint, you will be completely eliminated at $160,000 of income. The cool thing about this stimulus package, like the other ones, is there is no clawback. So we'll dig a little bit deeper into that when we talk about the 3 checkpoints. Initial stimulus checks have started to go out. Some people saw direct deposits starting over the weekend. Those would be generated by either the first or second checkpoint. I broke it down into what I'm calling 3 checkpoints as an easy way to think of when they're going to capture this. So the first checkpoint is your 2019 return on file. If you haven't yet filed your 2020 return and your AGI, or your adjusted gross income as a married filing joint couple, was below $150,000, well, you'd be eligible for this stimulus. That's based on your 2019. Let's say that you weren't eligible in 2019, but you were in 2020. And if you already filed, well, you'd still be eligible in this first round. The next phase would be when you file your 2020 return if you have not yet already. When you file your 2020, you might be eligible at that point, in which case you would be eligible for that stimulus. Your third checkpoint is when your 2021 return is filed. And when you look at that, well, heck, I got 3 tax years up there. You might say, well, wait, why are we covering 3 tax years? Well, the way that the bill is structured is that it is a forward paid tax credit for 2021. They're drawing under the assumption that whatever your most recent tax return on file is roughly what you're going to earn this year. So if you qualified in 2019, you'll get the stimulus payment. Let's say a month later, you filed your 2020 return, and well, you wouldn't have been eligible if that was on file before. They're not going to claw back. They're not going to take that money back. Let's say that you weren't eligible in 2019 or 2020, but in 2021, your income was quite a bit lower, thus making you eligible. You would receive a tax credit in the future on your 2021 tax return. So this can bring up an interesting piece. Are you able to lower your income in 2021? So if you weren't eligible for 2019 or 2020, can you restructure your income, especially if you're in retirement? Can we draw from some other tax buckets to reduce income? If you're single, I'll say there's 1,400 reasons to get below 75,000. If you're married filing joint with 0 dependents, well, there's 2,800 reasons to get below 150,000. Let's say you're taking care of another adult at home or have other dependents. For each one of those, that's 1,400 reasons more to lower your income in 2020. And if you're married and have 10 kids, well, you're just a saint. I don't know. You have way more patience than I do, but you could earn up to $16,800 in a tax credit or stimulus payment if your AGI was below 150,000. So I encourage you to take a deep look at your income for 2021. Now, if you're fortunate and your salary is significantly higher than 150,000 or 75,000, you're married, filing joint, or single, of course, there's not really much we can do. But if you are in retirement and you have some after-tax assets, it'll be worth taking a deep dive into your tax plan for this year to see if we can reduce income enough to get this. If you're married, filing joint, that's an additional $2,800 off of your taxes. So schedule a tax opportunity meeting. If you think that this might pertain to you and you might have an advantage by doing this, I very, very, very much encourage you to schedule a meeting. We can talk through it one-on-one and get into a lot more detail in your individual plan. Of course, I can't give individual advice on this, so I am going to send out in the chat function a link here to everyone. And if you click that link, you can schedule the meeting now. I will send it in a post-event email, so don't worry about it. If you're struggling, switching back and forth between Zoom and this link, I will send it to you again. But if you think that we might be able to get income low enough to qualify for that, if you haven't already, please schedule that appointment. It'll benefit you drastically. Let's jump back into the presentation now. All right, guys. Okay. Oh, Zoom is giving me a hard time today, guys, so bear with me one moment. All right. Hopefully everyone's still with me there. Zoom is not allowing me to share my screen, so if it doesn't come back up, we'll simply talk through it. But we should be okay after I restart it. Okay. So again, schedule that tax opportunity meeting if you think that there is going to be an opportunity for you to potentially lower taxes. Now let's move on. Expanding the unemployment benefits. So as of the end of February this year, we had 4.1 million workers that were 27 plus weeks out of employment. So they lost their jobs and they're sort of hitting this wall of we're not going to receive unemployment benefits anymore. So part of the bill is to continue unemployment, so federal subsidies to states to extend that benefit. We also saw the extension of expanded benefits for certain workers that are normally excluded, like self-employed individuals. We do see that extra boost or that PFUC, a $300 increase. All of those are set to expire now at September 6th. So we push that back out. So if you're unemployed or know someone that is unemployed, that is certainly a big plus for you. Another piece that was pretty cool in that is if you received unemployment last year, you can avoid paying taxes on that unemployment. Normally, unemployment benefits are fully taxable. If you received unemployment in 2020, in the bill, you are eligible to not pay taxes on up to $10,200 per person. So if you and a spouse were both unemployed, up to $20,400, but your AGI must be less than $150,000, including that unemployment income. So again, if you think that you might fall into that category, the IRS is saying at this point, let's not cause any problems here. let's instead keep on continuing to file tax returns, and we'll get back to you. So they haven't said definitively, hey, we're going to give you this credit at this time or the other. At this point, we're just waiting for further guidance. But hey, keep it in the back of your mind. If you received unemployment, you might be able to avoid taxation on that. Federal support for health insurance. Cool piece of the tax bill here is COBRA subsidies. So if you lost your job, you have the ability to continue on COBRA. Well, for most people that have lost their job, if you looked at the cost of that unsubsidized insurance from the plan that you had at work, you probably did one of these where you opened up your eyes pretty wide and said, oh my gosh, that's so expensive. Well, good news. The federal government is going to give a payroll tax credit to employers that continue to pay that benefit for employees. So that's a huge benefit. Yeah, so no more to say on that other than if you lose your job, hey, you might be able to keep your same health coverage at no cost. There has been enhancements to the premium assistance tax credit. Now, what the premium assistance tax credit is in Obamacare, if you buy health insurance through the health exchanges, based on your income, you can receive a subsidy or a premium assistance tax credit to help manage the cost of that health insurance. So they've enhanced it. They've changed some of the limits to make that out-of-pocket cost lower. Another good piece with that is, well, I guess in a little bit more detail in that, if you fall in the lowest income bracket, which we do have some retirees that have assets, choose to withdraw from savings to bridge the gap to age 65, a silver plan can be fully covered under the new bill. So it might make sense to take a second look at your health insurance plan for the year as well. Now, let's go back to 2020 and say, hey, you know what? If we bought health insurance through the exchanges, we gave them our estimated income because we were working a part-time job in retirement, taking a little bit of money out of our retirement accounts, but we were going to keep it below this certain level. And then, well, I got unemployment. With that initial $600 bonus, it blew my income out. And then I was at home, so I wanted to fix things up at the home. So I ended up taking out some more money. What has happened for many people is that their income assumption was quite a bit higher or quite a bit lower than what their actual income was. Well, they've said in this bill, we're not going to claw back any excess premium paid, or you don't have to pay back that benefit like you normally would. Another cool feature, if you're unemployed in 2021 for at least 1 week, they're going to assume that you fall into the lowest income bracket for the healthcare exchanges, which could make the full cost of a silver health insurance plan covered. So bottom line here, if you have any major changes in your employment situation, or if you're currently buying health insurance through the exchanges, it might be worth taking a deeper look at what your health insurance costs might be for this year. If you have more questions on anything on the new bill, I also sent out a brief email this morning containing sort of an overview of the bill as well. If you have more questions, again, schedule that meeting, that tax opportunity meeting, and I'd be happy to jump into additional details with you. Now moving on to the second point, taxes in retirement 101. Let's talk about the basics of taxation in retirement. In retirement, we say that there are 3 tax buckets. The first one is taxable assets. So these would be things, like after-tax investment accounts, any income you're earning in retirement, those would be fully taxable. Interest on savings accounts, those are taxable assets as well. While you're accumulating money, even if you're not using them, that yield, interest, or gain might be taxable along the way as well. The next tax bucket over is tax deferred assets. So these are assets that we can put away and not pay taxes on them until we withdraw them. So these can be things like your 401k or IRA, or a non-qualified annuity. So if you take after-tax money, put it in an annuity, it's not taxable while you're deferring it. It's only taxable upon withdrawal, just like your IRA and 401k. The third bucket that we have over to the right is tax-free assets. Well, tax-free assets, of course, are the best, right? Things like a Roth IRA would fall in this bucket. A properly structured life insurance policy could fall in this bucket as well, and municipal bonds. We'll talk a little bit more detail about those. So the taxable assets, again, short-term gains, stock dividends, interest on CDs, dividends and taxable distributions from mutual funds in after-tax accounts, tax-deferred buckets, your traditional IRAs, 401ks, 403bs, 457. In other words, your retirement plans at work, annuities, or savings bonds as well. Your tax-free assets, again, Roth IRAs, 401ks. What I really want to address on this slide is that little asterisk. And we'll get to this a little bit later. Those municipal bonds that you bought. Well, hey, they're tax-free, except they could make your Social Security benefit taxable. So again, we want proper diversification. Municipal bonds can be a great piece of a total portfolio, but we could still get hit with certain tax implications, like making our Social Security benefits taxable. So we'll talk a little bit more about that later. Again, our general goal is, hey, if we can move taxable assets over to the tax-free assets or tax-deferred over to tax-free assets, that's going to benefit us more. In retirement, it is helpful to have some money in each bucket. When we talk about controlling income, like this year, if our goal as a married filing joint couple is to stay below 150,000 in AGI, well, if we have some in tax-free assets, that's going to be really helpful. In fact, even the taxable asset bucket might be helpful because we might be able to withdraw a lot more from something like a appreciated stock or dividends from a stock to cover income rather than withdrawing it from our IRA. Okay, guys, so here are our 2021 tax brackets. These are if you're filing single. So any income, taxable income from $0 to $9,950 would be taxed at 10%. Anything from $9,951 all the way up to $40,525 would be taxed at 12%, et cetera, up through these tax brackets. Now, a common misconception that we see here is, hey, you know what? I, am making, let's say, $170,000. So that would push us above the $164,925 mark in the 24% tax bracket. So someone might say, hey, my income's taxed at 32%. Well, that's not quite correct. We get taxed along the way as we move up through the brackets. So your effective tax rate might be far lower, or in this case, would be far lower than that 32%. In other words, only the amount over $164,925 would be taxed at that 32% rate. Same type system works for capital gains. So if you own stocks and you're selling them, but your total adjusted gross income is below, or your total income is below $40,400, you wouldn't actually pay taxes on that money. Let's take it a step further. Okay, let's say that you do exceed that level and you fall in the next tax bracket, that $40,401 all the way up to $445,850 would be taxed at 15%, anything in excess over that, over 20%. So commonly we hear, hey, capital gains is taxed at 15%. Well, in a lot of cases, that's true. Now, let's also keep in mind with capital gains, if we have income, let's say in retirement coming from our IRAs of, let's say, $40,000, we have some Social Security income, and maybe some interest at the bank as well. Well, most likely we're going to already fill up this taxable income bucket. It's not only gains generated from capital gains, it's your total income. Of course, we can do certain things to offset that income, but sometimes that's a misconception there. We don't have to have over $40,400 in capital gains to get taxed at 15%. It's based on your total income. So moving on, same type tax brackets here for married filing joint. We can see in married filing joint, we get a little bit more leeway here in that 10% tax bracket, up to $19,900. Second tax bracket, $1 above that, all the way up to $81,050, et cetera, et cetera. If we look at how that fills up, so I mentioned with the filing single brackets in married filing joint, along with the single brackets, we tally up that money from the previous bucket. So if we maxed out this first 10% tax bracket, we'd pay $1,990, or 10% of $19,900. Anything over that amount, we get taxed at 10%. If we fill up that second tax bracket, we add the total of those two up, we're up to $9,328 and 22% with any money over that, et cetera, et cetera. So if we're reaching up to that 32% tax bracket, we're already paying about $67,000 in taxes. So we do start paying quite a bit more in taxes as we move up those tax brackets as well. Same type capital gains tax system here as well. Anything up to $80,800 if you're married filing joint, we could have a 0% capital gains. Now, this is important in retirement because, as we'll talk about later, your Social Security might not be fully taxable, and we'll talk about how that's calculated next. But if we're withdrawing maybe some money from savings in the early years of retirement for other reasons, like maybe trying to keep our income down to qualify for healthcare through the health exchanges, we might actually be able to sell off some stocks and pay 0% in capital gains. Sometimes in our working years, maybe we collect some company stock outside of our 401k or retirement plans, and it's grown quite a bit, so we have quite a bit of tax there. It may make sense in early years of retirement or years when we know that we're going to have lower income to go ahead and sell some of that stock and realize those gains. So always keep that in the back of your head as well. Moving on now, we will talk about how Social Security is taxed. And here we're going to talk about provisional income. Provisional income is how they assess how much of your Social Security benefit is taxed. In this case, we take 50% of your Social Security benefit, add ordinary income, so withdrawals from your 401ks, IRAs, interest in banks, interest from banks rather, and also any working income. So maybe you're thinking about claiming Social Security while still working. We'll need to add that in. That'll be a piece that could that works into the calculation to see if your Social Security is taxable. Next piece here, we'll take dividends and capital gains along with non-taxable interest. So I did talk earlier in the presentation about non-taxable interest. What that is the yield from those municipal bonds. So that is not taxable, but it could make your Social Security taxable. That's why I had that little asterisk there in the past. So we'll look at the thresholds for Social Security taxability. If provisional income exceeds $25,000 and you're single, 50% of your benefit would be included in your taxable income. Anything over 85 or anything over 34,000, 85%. If you're married filing joint, those same limits are 32,000, 44,000. Now, an interesting piece here is that these do not adjust with inflation, so they don't move up. That 50% threshold, or the 25,000 or 32,000, was set back in the 80s, and the second threshold, the 85% or 34,000, 44,000, was set in the 90s. So if we adjusted these for inflation, they'd be quite a bit higher. Well, if the Social Security and general tax system is stressed, one way that we can collect a little bit more revenue is not updating the numbers as inflation takes away spending power. We'll push that aside and move forward. So how do these brackets work? So let's run through a quick example here. Here we have $20,000 in Social Security income for a retired couple, along with a $40,000 IRA withdrawal. In this case, it gives them $50,000 in provisional income. In other words, we count all that IRA withdrawal plus half of the Social Security benefit. So let's see what exceeds that first threshold for this married filing joint couple. We take 50,000, subtract 32,000, gives us 18,000. We take that 18,000, multiply it by 50% or 0.5 to get $9,000. Well, let's see if anything exceeds the second threshold. Well, let's take 50,000 minus 44,000. We get $6,000. 6,000 times 0.35. So here we only want 35% more of that being taxed since we already calculated 50%. That would give us $2,100. Add these two numbers together, and we can see total taxable Social Security benefit in this couple's case would be $11,100 or 55%. Now, let's say we changed those income streams slightly, $40,000 for Social Security and $20,000 for an IRA withdrawal. And when I've run through this example in the past, I might get someone that says, hey, Josh, how do you double your Social Security? Well, in simplified terms, in this case, it could be a married couple, or in the first example, only one of them is claiming Social Security. In the second piece, maybe both of them have elected it. Of course, your unique circumstances are going to be a little bit more complex than this, but simplified example to help you understand the concept. Second piece that we have here, 40,000 Social Security, $20,000 IRA withdrawal makes provisional income $10,000 less. So we have 20,000 IRA withdrawal. We're going to count that all in provisional income. Takes 40,000 Social Security, cut that in half. 20,000 plus 20,000 equals that 40,000. Take the 40,000 minus that first threshold of 32,000. We have 8,000. 8,000 times 0.5 or 50% gives us $4,000. $0 over the second threshold. So $4,000 of our Social Security benefit would be taxable, or 10% of the total benefit. Let's cover the last section here because I realize I am already getting close to the end of my time here. This is what many of you probably want to hear, right? We all want to figure out how to pay less taxes. So tips, tricks, and pitfalls that we often see in tax planning. First one is your beneficiaries. Now, you might think that this is going to be an estate planning conversation now, where, hey, make sure that, you put your kids as your beneficiaries, remove any ex-spouses. Well, yeah, we do want you to do that. The other piece that we want you to do is to realize how much of your IRA or 401k has another beneficiary on it, and that's Uncle Sam. Uncle Sam is a part owner of your IRA or 401k, and if tax rates go up, it could be a higher amount to you. So I like spreadsheets. I like digging deep. I'll tell you what all this nonsense means real quick. We look at a 35-year-old that has $10,000 in an IRA. We grow that $10,000 at 9% each and every year. And let's say that individual retires at age 65. Well, that $10,000 has now become $144,618. Okay, let's say they're retired, so they're going to be a little bit more conservative in their asset or in their allocation. They're only going to earn 5% moving forward. Well, at age 72, we have to start our required minimum distributions. Or the IRS says, hey, based on your age, you need to start withdrawing a certain amount from your retirement, from your qualified retirement plans each and every year. Under this example, those assets continue to grow, would be about $193,000, and we take those appropriate withdrawals. Let's say that this individual passes away at age 85. The remaining balance in that account is $186,525. In other words, throughout retirement, we had total taxable amounts of $328,457. Okay, well, so what? What does that mean? Well, let's draw an assumption. Let's say that they're falling into a 20% tax bracket. So maybe they have pension, Social Security as well. They're paying effectively 20% on every dollar withdrawn from this account. That would mean they pay $65,914.40 in taxes on a $10,000 deposit. Now, granted, there's a lot of time that passes by here, but we need to realize that that's a pretty big chunk of the asset. Even at retirement, if it's $144,000, the balance, well, the beginning of retirement, it's hard to think that maybe half of that account value is Uncle Sam's. Now, by no means am I saying, hey, rip all your money out of the IRA and pay Uncle Sam today, because you might actually pay far more than 20%. But we need to plan for that. We need to know that Uncle Sam's on this account as well. Another way to look at that is with your required minimum distributions. So going back to this chart, maybe we could look ahead, draw some assumptions, and try to figure out what your RMDs might be in the future. We can look at what tax bracket that would put us in. If it's in a higher tax bracket than we're in now, well, it might make sense to do some Roth conversions today. If we don't need that money, so if we're forced to withdraw more than we think we'll need for income, it may also make sense to do a Roth conversion. So if you haven't done that sort of analysis, or maybe you did it a few years ago and, well, there's a lot of changes in the tax plans now, let's revise that. Let's update that. So go ahead and click to schedule that tax opportunity meeting, and we'll dig deeper into your situation there. So required minimum distributions. Government's going to tell you at age 72, you need to start withdrawing from your qualified retirement accounts, your IRAs, 401ks, 403bs. We need to have a good idea of what those might be in the future. Of course, we don't know exactly what the growth will be, so it's a guess, but we need to have an educated guess on that to see what the tax impact might be. Now, let's say that we know that it's going to be quite a bit higher, so we're going to slow down we're going to speed up Roth conversions in the early years of retirement. What else could we do? Well, once we're taking those RMDs, we can send a portion of that directly to charity. So let's say you normally give a certain dollar amount each and every year to the church or to a local charity. You can direct that money to go directly from your IRA to that charity and avoid taxation on that completely. Otherwise, it would be a charitable deduction, which we won't be able to take if we're not exceeding the standard deduction. A little bit more on that later, because we do have an exception again for this year in regards to charity. With the passing of the Secure Act, RMDs moved from age 70 and a half to age 72. The cool thing is we can still do this direct contribution to a charity starting at age 70 and a half. That part of the rule didn't update. So if you think that you're going to have a tax problem with your qualified accounts, well, we have a little bit of extra time to direct that money directly to charity. So we can save a little bit of taxes there as well. The other piece is, well, if your kids inherit your IRAs, they're going to have to distribute it over 10 years. In most cases, there are certain exceptions. So we need to think about, hey, if kids inherit the account, what are their tax brackets going to be at the time? For most individuals in retirement, their income might be lower than their kids in their prime earning years. So we need to structure appropriately to make sure that family's getting more money than Uncle Sam, right? We all like Uncle Sam, but most of us like our family more. Back to the charity piece. Another thing that we've seen missed on 2020 returns that we've reviewed so far is the above the line charity tax credit. So last year, as part of the CARES Act, every household or every tax return, we had the ability to take off $300 if we contributed that to charity. In 2021, that's been renewed with the stimulus package at the end of last year. It's been renewed, but it's also been expanded. So if you're married filing joint, it can be up to $600. So, hey, you know what? If you are giving money to charity, make sure, even if you're taking the standard deduction, you keep track of that and make sure you mark that down on your tax return. If you did receive a stimulus payment, and we've heard from many clients, in fact, I got an email last night as well. Hey, you know what? I'm always grateful for extra money, but I don't necessarily need it. Are all these stimulus packages just going to cause us more problems? It's a big question in our country now, and I don't have a perfect answer for it. But hey, if you feel like maybe I didn't need this, this is a good baseline of an amount of money that you can contribute, maybe to a local charity to help some of those that are more in need and get a tax reduction for it as well. Another tax tip for those in retirement that we see being a huge help, and I mentioned it a little bit early, is diversifying your tax buckets. So having a little bit in each tax bucket. If we could make a completely tax-free retirement, that would be fantastic. In most cases, that's not possible. But by having money in each of the 3 tax buckets, we have some control. In fact, even in tax-deferred assets like your IRA, if income is low enough, you might not even pay tax on those. There is a 0% tax bracket, or if income is below the standard deduction, well, heck, we're not paying money on that IRA either, so we need to make sure we're aware of that. That comes into play with a tax plan. Many times we'll see early in retirement that in fact we can make a Roth conversion and pay little or no tax on it at all. That would help move tax-deferred assets over to that tax-free bucket. So I encourage you to look at diversifying your tax buckets early on in retirement to give yourself more flexibility. All right, I am 1 minute over time, so I'll wrap it up here in the interest of everyone's time. Again, today we talked about taxes, one of 5 pieces of a comprehensive retirement plan. If I raise some questions for you or some areas that you feel you need to dig deeper, I encourage you to schedule that call. If you want to dig even deeper, well, for any of those not working with us, we'd be happy to do a complete retirement plan review where we look at things like income, investment, tax, health, and legacy planning to make sure that you're in good shape prepared for retirement. There's no cost to do so, just some time on your part, and of course some time on our part, but that allows us to get to know you better and see if we might be a good fit. For those of you working with us that feel like, hey, maybe we need to look at my tax plan a little bit more, schedule that call. This is your time to revisit that and make sure that we're both on the same page, especially if there's new information in your plan. Again, I encourage you all to fill out the form. I'll send a link to the form in the follow-up email and in just a moment, and schedule that tax opportunity call. In the follow-up email, I'll also have links to our social media. If you follow us on any of those pages, you'll get the opportunity to have a 3rd entry into the plan or into the drawing for the $25 gift card. I recently heard an analogy that made a lot of sense to me. They said, hey, you know what? We can all learn pretty much anything at this point if we spend enough time researching it. So if you were in a car accident and you were driving down and you were driving down the street, you were in a car accident and you're parked off on the side of the road and of course kind of shooken up, and the ambulance just drove by, threw a first aid kit at you and kept on driving, that wouldn't be very helpful. I encourage you for jumping on the webinar today. But if you aren't already working with a financial advisor or haven't had someone look over your plan, I encourage you to have the paramedics stop and look at you a little bit more rather than just throwing that first aid kit at you. First aid kit's not much use if we don't know what might be wrong with us or we're not able to diagnose symptoms. The tax code is extremely complex. It's constantly changing, especially over the last group of years as well. So I encourage you to schedule a time. Hey, take a half an hour out of your time, do a little bit deeper of a dig on that. As I promised, I will send the link out to that survey real quick here, and we will wrap up for today. If anyone has questions or concerns, I really encourage you to schedule that 30-minute call. As I mentioned, you can choose to do it as a Zoom call, or if you prefer, you can simply do it as a phone call and we can talk through it. Of course, the Zoom allows me to share my screen and gives a little bit more detailed in the analysis. I hope everyone enjoyed today's presentation. Again, in the form, we'll ask if you know anyone that might benefit from these in the future. If so, please share their name and information with us. I'm not going to call the people or attack them. I'm just going to simply send them the invitations for all of those moving forward. Again, thank you everyone for attending. Keep an eye out for the follow-up email and have a great day.